we're making the case for a US dollar comeback here today. Might not be a popular case, but seeing a couple of things that could be the start of a US dollar comeback here. And you look at the current market for USD against the Swiss franc, the British pound, and the euro, and it's been better for US dollar as you look at the rightmost part of this chart, especially the Swiss franc in that black line has gotten all the way back to multi-year highs that we saw in the middle part of 2020. And if you break that data out to more years, the Swiss franc is at its most valuable against the US dollar in many, many years here. British pound and euro, not quite to those highs, but it's been a rally of 95 cents all the way up to 110 for the euro. British pound from 105 all the way up to 125, as the last 6 months has been really tough for US dollar, but feeling like we might be in the midst of a little bit of a reversal here, if not because of the price action, the fact that we've just gotten to extremes here, and foreign exchange markets do tend to mean revert. And so maybe we will see a little reversal just off of the price action, maybe off of a couple of fundamental and technical reasons as well. And I want to rope in interest rates here, because in the US, there's a lot of talk of the U.S. is going to be cutting rates because of X, Y, and Z, and that's why the U.S. dollar is getting beat up because the U.S. is the weakest, and what have you. A lot of these different stories. U.S. interest rates are still a healthy amount higher than every other global power here. Euro area under 4%. U.S. You'll remember just last week hiked to 5.25%. UK and Canada, the closest, but still almost a full percentage point, a full 100 basis points behind the US. And then you break into Switzerland and the Swiss franc that has gotten back to multi-year highs against USD. And the US has almost 4 percentage points more worth of interest rates, and rates factor in considerably to Forex markets, because if you're holding a foreign exchange pair, you're long Swiss franc, short US dollar for even one night, you're going to be taking in the Swiss interest rate. This is called the carry trade, by the way. You can take a look at, we've done content on this in the past. If you're long Swiss franc and short US dollar, you're taking in 1.5% and you're paying 5.25%. And so you bet that these interest rates factor into the demand for these different Forex pairs. And even with the US having the highest interest rate here, US dollar has been getting hit for the last 6 months. And I brought up this piece of, yes, a lot of this is on the future here, and the fact that the future for the U.S. Looks like they'll be cutting interest rates as soon as the end of this year. And these are numbers from the CME saying that our current interest rate at 5.25%, that's all well and good. The market is thinking that we'll be 100 basis points lower than that by the end of this year, which, all things equal, would still be higher than the Eurozone, than Switzerland, than Australia, than Japan, way higher than Japan, who's still at negative 10 basis points. But also something that, of course, markets are some of the most efficient things on the planet. And so all of these things that are shifting are constantly being priced in. And I'm not going to jump on here and say, hey, they're forgetting about this. It hasn't priced in this. But I don't think that this Forex market has necessarily looked at the fact that, yes, U.S. interest rates are projected to be lower, and that has probably caused a lot of the weakness in USD over the last 6 months. But correlations between what these central banks do is extremely, extremely strong. And so I would be very surprised, and historically speaking, it would be quite a surprise if we saw the U.S. take down their interest rates to 4% or 3% or even lower, and the UK and Eurozone and everyone else hang in higher for, years. It's just not how it's worked. We just saw, off of the pandemic, every central bank brought their interest rates lower. After that, coming through this inflation that we've seen spike globally for the last year and a half, 2 years, everybody has brought their interest rates higher throughout all of that. And so maybe a little bit overdone, this idea of U.S. cutting rates, but the UK and Eurozone aren't. I would almost expect that correlation to hold strong. Also, you want to bring in the U.S. specific risk of this, and the fact that, of course, the U.S. dollar is going to be weakening. The U.S. economy looks like it's in shambles with this regional bank crisis that's occurring, and it seems like every week a new regional bank in the U.S. having problems. But here's the deal. This should, at the end of the day, go out one of two ways. One, the regional banks, the handful of them, and maybe they find a couple of more, are siloed from the rest of the economy. I mean, look at the NASDAQ. The NASDAQ is making new year-to-date highs, it seems like, every week in the midst of this regional bank crisis. So if the rest of the U.S. economy and the world is siloed off from this problem, then it should only account for so much risk to that U.S. and U.S. dollar here. The other way is it starts to bleed over to the NASDAQ stocks, and it starts to bleed over to other economies, Canada and everyone else across different continents as well. Because if it's not siloed off and it's really going to be a bigger problem here in the U.S., I would be very surprised if, we haven't really gotten a crisis in the last several years, historically speaking, that has been just the U.S. or just China or just the Eurozone. Of course, it affects these different places in different ways. But if U.S. banks are going to be affected and really see some problems, some risks come up from the fact that interest rates were spiked so high so quickly, they were caught off guard, and Euro banks and Asian banks aren't going to see the same, I'd be very surprised. And so either it's siloed off or it's going to be widespread. Either way, the U.S. dollar is, either being hit too hard by this potential for fear, and it's actually not that big of a deal. Or if this becomes a widespread problem here throughout the U.S. and throughout the globe, that U.S. dollar might again become the flight to quality that we saw coming off of the pandemic. That was obviously not a crisis that was siloed off to one place. And then also, you want to bring up the debt ceiling. That's very obviously a U.S.-based problem. It's the U.S. debt. It's the U.S. Treasury that stands to potentially default. And the outlier risk here via the skew index, which is the S&P 500 2 standard deviation index for how much people are paying for insurance, essentially, at what are options prices in that 2 standard deviation range. If you know the VIX, that's the 1 standard deviation range. So a similar kind of concept. And you're seeing here the skew index showing you it's the highest in the last year, the highest prices that we've seen for those outlier 2 standard deviation options on the S&P 500. Yes, outlier risk has heightened here, the highest that it's been since the start of 2022, but it's outlier risk, right? Like the fact that option prices have gone from being, for the sake of conversation, 50 cents, 2 standard deviations out, and 2 standard deviations would be about a 3% chance of this event occurring. Maybe they've gone from 50 cents to 60 cents or 70 cents, what have you. Yes, it's something to note and something to monitor, but there have been plenty of occurrences when either the skew index or the VIX index has jumped up higher on some perceived fear, and then just been completely alleviated without necessarily a run up to full-blown crash, full-blown crisis. So all these different things that are weighing on the US dollar for the last 6 months maybe starting to let up a little bit here, and in the medium to long term can definitely be either attributed to those other regional territories or walked back here in the US. Makes me wonder if this is, the top in fear for the US and the top in certain currencies like the euro or British pound against USD. And of course, the other case, the case opposite this would be, well, euro's only back to 110. It could get to 120. Of course, it could keep going. The US dollar could keep depreciating, of course. But it has been, a hell of a run of these currencies causing the US dollar to depreciate. And for a couple of reasons or another, that US dollar could become the flight to quality again here, or there could be no reason for a flight to quality and some of these US risks could be alleviated. Either way, I think a really interesting moment for that US dollar and potential case for it making a little bit of a comeback here in 2023.